So now without further delay, let's begin today's event, sponsored by Canon and hosted by American Banker and Source Media Research. It's my pleasure to introduce your moderator for today, and that is Penny Crossman. Penny, you have the floor.
Thanks so much, Greg, and welcome everybody to this webcast. Much of the mortgage industry is on a quest to modernize technology. To some extent, it's reacting to competitive pressure. The market share of shadow banks, in other words, online and fintech lenders in the mortgage market, nearly tripled between 2007 and 2015, from 5% to 15%. In 2016, 6 of the top 10 mortgage lenders by volume were non-banks like Quicken Loans, Loan Depot, and PHH Mortgage. Many of these tech-savvy companies with online lending forums. Some of the market share shift is the result of large banks pulling back in the wake of the mortgage crisis, implementing higher loan standards, and deploying TRID rules. But some of it is also due to the fact that mortgage providers now compete on the customer experience. And younger customers especially are searching for mortgages on the internet and then trying to find the easiest and fastest mortgage process. Research we're sharing today will lay out how mortgage lenders are looking to improve their processes and some of the ways technology can help. Our speakers today are Dana Jackson, Vice President of Research at Source Media, and Source Media is the parent company of American Banker. Dana oversees all our market research programs. She has more than 15 years of experience conducting primary research and providing data-driven insights for business and consumer studies. And she has a Master of Science degree in Marketing Analytics from Bentley University in Boston. And we have Craig Hughes, who is Managing Director of Financial Services Consulting at CC Pace. Craig is responsible for business development and strategic planning, client relations, and operational management. He specializes in advising clients on process improvements and the innovative application of technology. And we have Michelle Roskin, who is Industry Marketing Specialist of Financial Services at Canon. Her primary focus is on business process analysis, automation, reporting, business analytics, and content management. Before joining Canon, she was at several mortgage institutions, including J.P. Morgan Chase. And we have Alyssa DeMeo, who is Associate Marketing Specialist of Strategic Solutions at Canon. Her primary focus is on cloud content management, email management, and specific vertical applications. So now for an in-depth look at our research, I'd like to turn things over to Dana Jackson. Oh, I'm sorry. So sorry. Actually, we're going to start with a poll. We want to find out what you in the audience are interested in improving in your own mortgage process. And we'd like you to pick one, please. Do you want to reduce cycle time, increase process efficiency, improve customer experience, or ease or streamline regulatory compliance? We'll give people another second to answer. And now let us look at the results. Okay, so improve process efficiency is the answer of more than half of the audience, and reducing cycle time and improving customer experience come in behind that. But that's a good fit for all of our content today because a lot of our focus is on improving the process, the mortgage process. So without further ado, I would like to turn things over to Dana.
Great. Thank you, Penny, and welcome, everyone. So as we mentioned, we'll begin this web seminar by just sharing some of the research findings that we got from a couple of studies that we conducted among mortgage lenders, and we did this in partnership with Canon. So you'll see a lot of some of the stuff that came up in that poll. So for this research, what we were really looking to explore were a number of areas in mortgage lending, specifically around loan processing. So for example, looking to explore, what were the top bottlenecks in the loan origination process and sort of those related pain points. Another question we sought out to find the answer, how manual is the loan origination process? So sort of what is manual versus what are those automated processes? And what are lenders' priorities for improving their loan processing measures? So what things are important to them? And then looking at technology and loan origination systems, what are the drivers for purchasing those types of platforms. And then lenders told us what their plans were to either add on to upgrade, or to replace their LOS platforms, and some of the timelines they were looking to do that in. All right, so first, let's just look at how we conducted the research and then the audience that actually participated in the studies. So we did 2 online surveys. We had a main survey that we conducted in March of 2016. We had 310 respondents for that study. And then we did a follow-up study later in the year in December, a little bit more around the technology, and we had 220 respondents for that. So these respondents were all, mortgage lenders. They were at all size banks and credit unions, and the respondents actually came from American Banker's opt-in audience, and I should say that they also came from our other publication, National Mortgage News, as well. So we had a lot of good qualified respondents for these studies. They were all self-identified as being a decision maker or an influencer in the mortgage loan processing. So they were all high qualified. Either they were making the direct decisions themselves, or they were somehow part of the mortgage lending activities. And then you can see the job titles that we had here. So these are all relevant roles around loan processing and underwriting and loan officers and customer service. We had compliance folks, loan closers. So a wide variety of sort of functional areas, and the titles ranged from the highest level C-suite to senior executives. We had a number of directors as well as the managers. Okay, and then just in terms of the size of the lending institution, they were all sizes. So it's good to hear from all size institutions. There were banks, there were credit unions, everything from sort of the the smallest institution all the way up to the very large national. Okay. All right. So let's begin by looking at what those bottlenecks were. And so we did ask the question, for each of the steps associated with your institution's loan processing function, how much of a bottleneck are each of these? So we're showing here those steps in loan processing, and what we're showing is the results of what folks could pick on a scale, a sort of a bottleneck scale. Everything from, we asked them, is it not a bottleneck? Is it a low bottleneck? Is it a moderate bottleneck? Or is it a high bottleneck? So what we're showing here are the percent of respondents who said that these were high bottleneck activities, all right? So you can see, reviewing the application and the supporting loan documents, certainly at the top of the list, contacting third parties for appraisals and titles, another sort of top bottleneck for people. And then sort of you had these other sort of middle areas around submitting the mortgage application, et cetera. So, and so on the side there, we also collected, I would say, sentiments from the audience, and we had a number of open-ended responses that we got some great input on. And so you can see here that somebody actually said that, it's about maximizing the time and the speed in the mortgage loan process. So streamlining was sort of a high priority for them. Okay. So related to that would be just sort of the loan process pain points. So we asked everybody what they would say were their top pain points in the current loan process. So these are the percent of people that mentioned these pain points. So you could select all that applied, and so you can see compliance, cycle time, certainly the top 2 mentioned pain points here. And then technology lags is another sort of next tier down, employee performance, customer experience, and document security. So, from the perspective of the respondents, these are their pain points, and, somebody commenting over here about, having a system of record and an audit trail. Okay. All right. The next question we looked into was we wanted to see sort of what the level of manual versus automated processes were for each of these steps associated with loan processing. And we had another scale there, everything from fully automated to mostly automated to sort of equal automated, manual, mostly manual, and all manual. And so what we're showing here is the percentage of respondents who indicated mostly manual or all manual. So, keeping in mind that manual processes can introduce errors and redundancies, you can see that reporting discrepancies in appraisals, titles, or surveys, reviewing the application and the supporting loan documents, verifying application information. So these are really sort of the top manual processes. Those on the bottom, a little bit more automated, submitting mortgage applications, files to underwriting, creating and sending the approval or the denial letters to applicants, a little bit more automated there. Okay, and then somebody, emphasized that they would like to eliminate the manual work and reduce the chances of errors. All right, so I would imagine that everybody was expecting the customer experience element to come in at some point, and it certainly does here when we're talking about priorities for improving the loan processing measures, and these were, what their priorities are in the next 12 months. So, certainly high or critical priorities for customer experience, for efficient processes, regulatory compliance, and data accuracy. I would say if you kind of look at these bars, they're kind of sectioned out by 3 different sort of steps. Another sort of middle section there around meeting expiration dates and rapid loan processing cycle times, et cetera. And then down at the bottom, relatively lower, you're talking about disaster recovery and version control of documentation and even paper handling. So, so lower level, priorities, but nonetheless important. All right. And so what's driving, lenders' LOS purchases? So this is something that we explored actually in the follow-up study that we did later in the year. And we asked how important each of the following were when considering an LOS. So all of these are, features that you would consider. It was a 5-point scale, and so what we're showing here are the percent of respondents who are saying that these features are either important or very important. And so compliance and regulatory and reducing manual processes, right at the very top, no question that those are, features that they consider, most important when considering an LOS. All right, then the next question we asked around the technology was, how likely are you to do each of these in the next 12 months? And so we presented them with 3 different choices here. The first was, add on to your platform. Second choice was upgrade your platform, and the third choice was replace your platform. So you can see that, 34% said they plan to, complement or add on to their platform. So that's sort of the certainly the most popular there. And then upgrading their platform was next, and then totally replacing it a little bit lower. And again, these are the folks that said they were likely or very likely to do each of these. And then you can see on the side here, a conversation about replacement and having to do a lot with the process and the customer experience. All right, and then looking at the timelines for those add-ons or those replacements, we asked them when they plan to do any of these. So again, we have the folks who wanted to do the replacing, the upgrading, and the add-ons. And you can see that sort of the most near-term, most likely to happen are the add-ons. So between the next 3 months, which is the dark gray on the left, And the next 6 months, which is the dark blue, the next block, I mean, you're looking at 50% of those who are planning to do some type of add-on happening within, a 6-month, period of time. So, and the replacements are certainly a little bit further out. All right, so that gives us a sort of a good sense of sort of what's going on in the market, what people are thinking, and then just to sort of the key takeaways here, common bottlenecks are really the application review and contacting those third parties, related top pain points around compliance and cycle time, manual steps predominantly tend to be around the discrepancy reporting, application review, application verification. Near-term priorities are really sort of focused on improving customer experience, creating a more efficient process, regulatory compliance, and then data accuracy. Those were at the top in terms of their priorities. And then in looking at their LOS purchase considerations, the drivers when they're considering those types of systems, compliance, reducing manual processes and cycle times, improving that customer experience, and reducing expenses are clearly what's driving those purchases. And then lenders looking to add on to their existing LOS, more likely a sort of a near-term decision, while the replacement timelines are probably further out. Okay, so with that, let me hand it now to Craig Hughes, who will talk a little bit about what he's seeing in the market around mortgage loan processing.
Thanks, Dana. I'm Craig Hughes. I'm a managing director at CC Pace, a management and technology consulting company, and my practice is the mortgage industry and financial services. As Dana indicated, I'm going to kind of build on some of the information provided in the source media survey findings, and particularly looking at some of the impacts of regulatory compliance on our origination processes, some of the key constraints and bottlenecks, and why some of these things aren't individual standalone problems, but they feed on one another, leading to process inefficiencies, the need for better automation, and ultimately wrapping up with some more discussion on why there's a growing focus on the customer experience. Regulatory impacts. The frequency of regulatory change since the credit crisis, I think we would all agree, has been unprecedented and highly disruptive. The nature of the changes are requiring significant modifications to our lending platforms and, in fact, the processes themselves and our interactions with third parties. Beyond just the amount of effort that we have to put into our systems and our people processes to be compliant with the regulatory changes, the assimilation of those changes and moving towards a new state of normalization for the process always takes a lot of time. There's a lot of uncertainty and fear of reprisal that goes along with the regulatory changes that leads us to at least a prolonged period, of extreme caution. Manual processes are often added on top of the automated processes to have the safety nets and double checks for our compliance. And when all else is, when nothing else works, when in doubt, delay the closing as the ultimate step taken to ensure compliance, much to the chagrin of our borrowers. The compliance requirements and resulting transaction complexity is certainly increasing the number of third-party services that are being commonly used throughout the loan origination chain these days. Having an integrated access to a wide variety of those third-party services, the ability to readily share data with them is really crucial to the process, more so than ever before. Regulatory change prevents increasingly any last-minute changes, meaning that we have to get everything right or reasonably right as early on in the process as possible. We can't just clean things up when it hits closing anymore. automated ordering, intelligent workflow are things that we strive for to try to save time and effort, but they're predicated on real-time data availability between the parties and between the systems. It's critical to make sure that when you're sharing data that everybody's sharing the same data or the results are not what we would want them to be. Driving process by business rules triggered by documents and the data that we're receiving is also key. Automated data validation then becomes important to reduce manual checking. When we're not sure that we're all working off the same data, it increases the amount of checking that we need to do, the manual processes, and so moving towards digital or smart documents, increased use of OCR and other technologies to try to transform what's on the paper to what's data in our systems is increasingly important. On this slide, we put a call out about a key trend of outsourcing compliance, which is not really new. We've been doing this increasingly for many, many years now, but at an unprecedented level, I would say, in the number of tools that we can use. This helps us with the lack of qualified staff in-house to deal with compliance, gives us additional assurances, more things to make us believe that we are in fact compliant. But the downside of relying on outsourcing for compliance is that it's another point of data interaction. It's another third-party service that we need to integrate with and ensure that everything is in consistency across platforms in order to get the results we want. Looking at a couple of the specific third-party interactions that rank very highly on the highly manual and key bottlenecks lists from the survey, we would put appraisals, and then on the next slide we'll talk about dealing with title. Appraisals, many in the industry refer to as the long pole in the tent. It is one of the most critical time activities with a defined time limits where things need to get done. Part of this is not just a technology issue, but we're dealing with an appraiser workforce that's declining, while at the same time regulations are increasing, making it very, very difficult to be timely in our activities. Too few qualified appraisers means that there are long wait times often. The pace of the aging of experienced appraisers is far exceeding new entrants into the field. Regulations restrict loan officer interaction with our appraisers. There are many constraints around that, and too few lenders actually begin the appraisal request immediately upon intent to proceed. So you're starting off kind of a little bit behind the curve in many cases. Very few appraisers or appraisal management companies actually automate the logistics to limit those scheduling issues to the way that we would like to see them ultimately. We believe that the appraisal industry should start looking more and more like FedEx or UPS in this regard, as far as their contact with the borrower or the homeowner to be able to begin the appraisal, and not looking like USPS, which I feel that they do in too many cases today. We have used in the industry in the past broker price opinions, automated valuation models, and things like that to try to stay ahead of the curve and get easier valuations, but they're out of favor and have been since the credit crisis, and it remains limited acceptance for those model uses to help us overcome the shortcomings in the appraisal market. When it comes to title, ordering title certainly cited as another key bottleneck. Manual title ordering and closing document collaboration is the norm today. When we say manual collaboration being the norm, we're really talking about both sides of the equation, the settlement attorneys and title companies and the lender rekeying data and pushing data back and forth where you're potentially creating errors, certainly in consistency between the two platforms. But that's the norm, pushing that back and forth until we consider the documents to be correct. Integration between the parties is difficult because we've got large dynamic bidirectional data sets that have to be dealt with and many, many players. There's so many mom and pop settlement attorneys and others that are preparing the documents, that's very difficult to get comprehensive integration. We would view that innovation in this space is somewhat limited. There are shared collaborative platforms evolving, but adoption is low. And again, there's many players that would have to adopt, and deciding what to adopt, it kind of limits the progress in that front. Things like CRID, again, regulatory issues that we've had to deal with, their learning curve of this process remains somewhat daunting. It's not just documents, but behavior, the way that the traditional behavior between title companies and the lenders have to behave, what they can and can't say to each other, things like that are causing us to relearn the interactions between those parties. Clear and early communications and for fee retrieval and other aspects are very critical. You can't make late changes, and closing can't rescue you when problems occur upstream. All this leads us to recognition of a lot of process efficiencies in our mortgage lending platforms today. The loan origination process is simply not automated the way that we would like it to be. Inefficient interfaces necessary to third party results in the need for manual processes and validations throughout. We're too often dealing with pictures of paper even when we go paperless. We're not really dealing with data that's on the paper in a way that we can ingest it into our systems and drive our processes. Stare and compare remains the most common validation process, and increasingly we're staring at two screens to do stare and compare rather than looking at a piece of paper and a screen, but it's still stare and compare. The workflow is not being triggered by the receipt of the key documents, but manual intervention with the system to tell the system that we received these documents. Handoffs between departments are very inefficient in that we still have within our own shops distrust between groups, so that when something moves from processing underwriting is double checking, and that's going on again when it hits closing. Checkers checking checkers remains the norm in the industry, and even more so with our concerns over today's regulations. Technology, simply put, should do a better job of helping force accuracy while recognizing that we still have exceptions to our processes. Very often we try to implement workflow, but only to find ourselves hamstrung and that we can't really change and move fluidly through the ups and downs of a loan the way that we'd like to. Business needs to do a better job of trying to systematize those business rules, understand what are exceptions and what are acceptable exceptions to make that process work better. As we look at how do we reduce the deficits that we deal with, data accuracy requires that consistency across the documents and the service providers that we're dealing with. Studies have shown that most often the deep defects are a result of labor-based processing, meaning manual entry, and underinvestment in technology, things that could be done to help make us more efficient in that regard. Key contributors to defects are often manual data entry, which produce errors that once those errors are in the system, they flow through the system. Non-machine readable documents prevent automated error checking. It leads to that stare and compare. Non-digital data documents preventing system synchronization, so multiple parties involved in the transaction are not dealing with the same data. Lack of automation to address these issues begets more manual processes. So if part of the problem with our data errors and defects deals with inefficient underspending in technology, well, why is spending lagging? And I think it's already been covered by Dana, but there are a lot of people unhappy with their lending systems and looking to change. We usually look at that it's a third, a third, a third. A third of lenders are happy, a third are complacent, and a third are unhappy. But an interesting part of that is that nearly a third, 30%, are often pointed to as believing that their systems are so bad that they actually provide them with a competitive disadvantage. So the nature of the underspending, according to recent Mortgage Bankers Association Stratmore Peer Group Roundtable data, most recent data showing that on average the cost to originate in the retail channel is over $6,000. Yet small and mid-sized lenders only spend $300 to $350 on technology. Conversely, the average spend that the large banks who are typically using custom or highly customized systems spend as much as over $1,000 per loan for their technology. The total cost of production rose threefold in the last 15 years, but tech spending is only up double. Spending less on automation than we would argue is not the most effective means to control total costs of production. Shifting the gears here, I'm going to move over to customer experience and why that's a top priority, as shown in the Source Media survey. I think the signs, I certainly find the signs of a newfound interest and rediscovery of the customer are everywhere. In our vendor offerings, the panel sessions and conferences are dealing increasingly with the customer experience, advertising even on at the Super Bowl on how mortgage business should be a good experience for the customer. Regulators are busily acting on behalf of the customer to try to make sure the customer's interests are upheld. Even Fannie and Freddie, the GSEs, are making their systems more aware of the customer. It's a B2B customer, it's the lenders, but they're trying to be more aware of the customer experience. And everybody's interested in what is the fintech, what are these new upstart systems and mobile technologies that are available to us, and how can they be deployed to improve the way we interact with our customers. Studies are showing that the consumer direct, that's the less intervention of the loan officer, is twice as productive as typical loan officer-driven retail. Many consumers simply prefer the self-service model for interactions, reducing the labor costs needed, but at a requirement of better technology to be able to extend that customer experience. The purchase market is shifting our emphasis, underscoring this need for the customer experience because customer experience currently upstaging lowest possible rate mentality that we have when we're in a refi market. So if we're interested in customer experience, probably a good idea to spend some time on, well, what do the customers want? Well, customers want fast, consistent, and one would say secure flow of information. They have to share a lot of information with the lender, and they want that to be done effectively. They want a clear timeline so that they understand what it is that's wanted from them, what their role in it is. They want transparency to be assured that things are going according to that timeline and plan. They don't like not knowing the steps and where they stand on the timeline. They don't like having to take initiative to find out where the status of their loan is. They want that to be self-serve, ready, and available through a portal. And they really don't like surprises or delays for things outside of their control. There's a timeline, there's a process, why aren't we keeping to it? Customers want a clear understanding, as I said, of what's required of them. They want clear, accurate lists of what they need to do, why they need to do it, and when is it needed by. And if provided with that, they don't like being asked for additional information. They want to know it up front, and they want to be able to make sure they're doing their part to make the transaction work smoothly. On top of that, customers want things their way. In today's world, we have so many different ways of communicating with people, and not surprisingly, customers would like you to communicate with them on the terms that they like to communicate. Some people like mail, some like email, some like text, some like phone calls. It can be any combination of those, but please try to do it the way that the customer wants you to communicate with them. If they don't like getting phone calls, why are you calling them? How about sending them a text? And ultimately, increasingly, customers want to know, is there an app for that? Things they can do on their mobile device to stay in tune with the transaction as it's moving along its path. The customer experience and ultimately reflects our process. Customer experience is negatively impacted by inefficient and processes and processing faults. Everything that goes wrong, our top pain points, compliance and cycle time, those things are actually tied to the customer because those are key factors influencing customer satisfaction. The lenders are concerned with the regulators, the compliance, and the penalties that come from that. But many of the things we do, are in direct opposition to how the customer would like things to be, meaning the compliance issues create delays, the need for additional documentation, neither of which are things that the customer wants to have to deal with. They undermine that customer satisfaction and break everything that the customer tells us about how they want to work with us in doing business. So it begs the question is, can we do a better job of focusing on the customer and make that mean that ultimately it results in better performance overall? Well, we can, but that requires better automation and better communications. So ultimately, good customer experience means thinking differently. We as lenders have to understand that the customer's journey is not always linear, and we need to be prepared for that. We need to work with them the way that they need us to work with them. With frequent, clear communication, certainly critical. Providing a menu of consistent integrated touch points, again, on their terms, helps the customer figure out how to work with us and how we can help them along that journey to a closed loan. Improving the customer experience where it matters most to the customer is critical, makes sense. Providing the right information and experience at the right time. Accurate borrower checklists can serve as a barometer for customer satisfaction. They want the information. They want it all laid out for them. They want to understand what's needed. Yet statistics show that less than 40% of the time do lenders actually provide the customers with accurate borrower lists of tasks that are on their plate to do. We need to make the process as smooth and as easy as possible for the customer. We need, which a lot of that comes with providing that transparency into the process throughout the life cycle. Ultimately, we need to get the basics right. As a critical driver to customer satisfaction, when surveyed, low customer expectations are more often than not the result of disappointing encounters where the very basics went wrong. And that's the end of my slides. And Penny, going back to you, it looks like we have another question for the audience.
Sure, thanks so much. So we also want to poll our audience about what kinds of technology you are thinking about implementing in your shop. Are you thinking about an imaging workflow system, an online lending portal, an information management system, or something else? And you can choose multiple things. Give you a second to answer. And now let's look at the results. So an online lending portal is the most popular. That kind of makes sense. And then imaging workflow was selected by a third. And after that, information management system selected by 1/5. So very good. Well, with that, I would like to turn things over to Michelle Rothkin.
Thank you very much, Penny, Dana, and Craig. That was extremely informative and very helpful. So good afternoon, everyone. As Penny mentioned earlier, my name is Michelle Rothkin, and I'm the Financial Services Industry Marketing Specialist here at Canon. I have here with me Alyssa DeMeo, who is a marketing specialist for our Strategic Solutions Group, and we're both very excited to be here with you today. We really hope that you walk away from today's session having learned something new about how technology can play an important role in today's business environment, and most importantly, ways in which you may be able to improve your day-to-day business outcomes with complementary technology. So when we think about the bigger picture from application through underwriting, these are the 3 highest cost contributing areas within the loan process, and the clock is always ticking. So Canon recognizes the need to automate as many of these steps as possible. We focus a bit more on the loan processing phase because, as you can see, it really can take anywhere from 45 to 70 days to collect documents and move the loan along to closing. So to Craig's point earlier, finding ways to reduce process redundancies and cycle time is very critical for both the customer and the employee experience. Alyssa, can you weigh in?
Sure. Thanks, Michelle. So, we've seen a continued trend in focus on improving efficiencies in processing. And, we believe in order to address this, the focus is on what we can do to manage the overall process supporting the current LOS. And by placing emphasis on improving the manual tracking, requests for documents, and follow-up activities, we can then effectively drive efficiencies in the process.
Right, and so the ultimate goal is to get to closing and servicing much quicker, as this is where the revenue stream happens. So if you sit in capital markets and you're behind the scenes, you know you can increase your revenue if you close and fund your loan prior to the lock expiration with the investor of choice. But obviously, the quicker you close, the quicker you start collecting on interest as an investor or on your origination charges as the lender or broker.
Yep, agreed. And, automating these steps leads to the ability to reduce excess costs for manual processes and turn it into then revenue, customer satisfaction, and repeat business.
Right. So let's just take a look back at Penny's slide and the automating opportunities as it relates to processing. So as you can see, the top bottlenecks that she was speaking about are around reviewing supporting documents, verifying the loan information, and contacting the third parties. We realize there's a high degree of time spent on following up with third parties to obtain outstanding paperwork, but also compiling that paperwork and then sending it around to review in multiple groups can be a challenge as well. These administrative activities are mentioned about 89% of the time. So, we think, what if we could put together a solution that would really reduce the time spent on those activities, as well as automating the capture and the reconciliation of some of those documents. And that would leave more time to focus on the actual verification of the information and the management of the discrepancies.
Yep, I think that is key, Michelle. Manual follow-up and tracking external from the LOS is just not efficient. So we need to be able to create a mechanism in the solution that allows for the tracking of all of those activities in a system that can help in the management of the heavy follow-up that is definitely required here. So we see implementing a tracking workflow as key in producing the results of effective processing, and then allowing for automated alerts that require follow-up or then identification of non-responsive actions for the potential borrower or third party.
Right, and then building the workflow tracking can alleviate some of that manual burden, allowing really for more time for the quality review, excuse me, and other key actions that a loan processor or underwriter would need to perform. So with that, let's talk a little bit about the cycle time. In the survey that Penny shared with you, 51% of the respondents state that cycle time is a top pain point in their mortgage loan process. And 76% of the respondents are stating that their top priorities are to improve the customer experience through a more efficient process, of course, which I believe go hand in hand, and as most of you addressed in the first poll question, a more efficient process. And if a borrower can close on time and their loan was worked on efficiently, then their experience will be a positive one, which obviously can in turn lead to repeat business and referrals.
Yep, and to expand on that a little bit, Michelle, if we enhance the processing environment by automating these manual steps, we can then become more proactive instead of reactive. And, that is where tracking workflows and dynamic interactions with third parties can increase efficiencies. By having access to dashboards that track activities and due dates, all employees that have an action pending can now target those items that require immediate attention. And examples are alerts for credit documents that were received and are initiated into a workflow queue for review within about 24 hours. This is not only much more effective, but, rather than waiting for someone to bring it to your attention, you have it right there for you.
Right, and the idea is to have the visibility into what's coming due and where you are in the workflow.
Yes, likewise, a department supervisor can have the same visibility to see where their staff is throughout the process.
Right, and now the department supervisors can show their value and increase their department revenues by reducing manual processes and redundancies. Setting priorities can allow for better process efficiencies. You can increase your revenue by having efficient processes that lead to reductions in costs, for example, due to less missed rate and document expirations. That also leads to a better customer experience, which can increase your revenue with, again, repeat business and customer referrals.
Yes, and this is key to allow the loan processor and other individuals involved in the loan process to then become more effective in the management of the loan process. By employing automation outside of the LOS to enhance those traditional manual processes, we can help provide improvements. If we can decrease the touch points and create integrated capabilities between the LOS, then tracking activities that are traditionally manual can now be automated, and external interfaces with third parties allow for interoperable communications. This can affect a transition for management to better achieve that customer satisfaction that you are referring to, Michelle.
Exactly. So then let's talk a little bit about addressing the needs of managing third parties. The key focus is to streamline the efforts of requesting, tracking, but also receiving the information and the documents. This is typically associated with, as you know, to Craig's point earlier, with title searches, appraisals, and other third-party verifications. If we can leverage those notifications by getting information quicker from these third parties and becoming proactive in follow-up, then we can gain control of the process.
Right, and this is where technology can assist in creating and tracking workflows that allow us to set notifications and reminders and alerts based on business rules. In addition, if we can leverage and create portals to allow them to upload documents directly to the information management system for processing as opposed to mailing them, then the third parties gain greater efficiencies and the information received is then validated. And now we can leverage automation to associate that document with the pending workflow task and then send an alert to the loan processor that the document has been received.
Right, and then the loan processor no longer has to spend time reaching out to third parties, but rather they can be notified when it's time for them to review the document that has arrived, therefore reducing the time spent manually matching it to the loan file.
Exactly. You know, and some key benefits of a solution such as that includes, for one, pre-approved vendors integrated within a system to streamline an online request for required documents. Another example is a web portal for third parties to submit documents back to a requester, which allows the uploading of documents through portals associating key metadata and automatic matching of documents to pending request. And a third example would be automatic notifications for pending requests, which allows proactive notifications to third parties without the need for any intervention.
Right, and I think that these functions are key. You know, the cost of working with third parties to obtain information to support the loan could be reduced by creating technology synergies with those partners. We all know that today is the day of electronic processing, so if we can make the request electronically and allow those partners to respond back electronically, we can then streamline the process. Even better, really providing them with a secure mechanism to upload their resulting documentation in a safe way. So then we move into business intelligence and visibility into the active loan pipeline. This is another big area that can improve the overall loan process.
Yeah, so going back to the web portal for Capture, you can have real-time analytics and measure performance trends, which allows organizations to leverage the workflow and tracking mechanism that allows them to build out dashboards that then provide visual depictions of what is actually happening in the pipeline, as well as for assessing employee and third-party activities and performance. So not only can it provide a method to assess what individuals are doing along with specific open activities, but then, you know, any effective organization needs to be able to measure key performance indicators to continue to assess and improve processes, which makes them more competitive. And, you know, of course, you know, you can't manage what you don't measure.
Right, and in order to truly capture KPI measurement, you need those real-time analytics. These KPIs should cover all points in the process, who's doing what items are due. So, for example, running reports for aging loan files, document and lock expiration reports, cycle time by processor, which, of course, can be built out by week, month, quarter. Really having robust data and features is what you need in analytics.
Yeah, and, you know, of course, we understand that one solution doesn't solve all problems, and the need to use different hardware and software to customize the day-to-day preferences in the banking institution then becomes the solution. So being able to integrate to loan origination systems already in production is key here, especially as Canon realizes that many banking institutions don't really want to change their current platform, but rather, you know, they're looking to upgrade and have a complementary system that can also act as an information management system. This includes things such as digital workflow automation or really a loan application case manager with capabilities such as optical character recognition, which then allows the system to route documents to the appropriate person with approved user-defined roles and will then enter their workflow queue. Not all documents come in at once, so being able to track, sort, and have version control is actually really critical here.
I agree. You know, essentially a systematic approach to manage the activities that are traditionally manual outside of the LOS is critical to address what you're talking about, and to gain the efficiencies that are needed to effectively do business in today's market. In addition, from that we see there are typical activities across organizations that are the framework of this automation need. However, you need a solution that will also allow you to tailor to specific business needs as well. This is where workflow systems and process management comes in to produce the desired results.
Yep. So, what are those desired results? What do those look like? So, for example, you should be able to automate and manage repetitive steps in document workflows to improve accuracy and help reduce cycle time. Communicating effectively within your organization and with borrowers to increase process efficiency. Improve the customer and employee experience with positive business outcomes via business analytics. Centralizing your document storage for tracking critical documents, version control, and safeguarding, sharing, and collaborating, all while complying with regulatory rules. And then, for instance, governance over rate expirations and document expirations, which then can in turn help reduce costs to both the bank and as well the borrower.
Thanks, Alyssa. That was a really good way to sum it up. And with that, I'd like to thank everyone for spending time with us today to talk about what Canon recognizes the needs of the industry are. So for the interest in time, I'll pass it back to Penny for some questions. I see we have some coming in.
Sure, yeah, we have time to get to just a few of the questions that people have submitted. We're going to start with a question I think I'll direct to Craig. The question is, do you have any figures on total savings by implementing a more automated solution? Craig, can you give any estimates or thoughts on that?
Well, I can't say that we have absolute numbers on those cost savings because it's such an individualized thing as far as what that's really doing. I do think that we need to, in general, when contemplating these things, we need to look at the overall total cost of ownership, in the equation, meaning not just worrying about what it's costing to get the system and get it up and running, but think about the long-term effects of the system. But unfortunately, that's just a way of accounting for it. But I don't really have numbers that are very very useful here as far as what you can expect from the automation, other than it should be improving. It should help lower the cost, but that's going to be different for every lender because they're going to implement things differently. Sorry, I can't give a better answer than that.
Okay, that's fine. And then we have a quick question for Michelle. There's a question about, can you explain better how task alerts work?
Sure. So the task alerts are pre-programmed by an administrator. So when a task or process is initiated, the next person in the process receives an email notification. You can also create a task view dashboard to view upcoming tasks, to manage them daily, to be proactive. So if unanswered, they can be highlighted in a red dashboard to call them out, but also be expedited to a supervisor. The alerts can be process or document specific. More importantly, if the tasks go unanswered, there are measures in place to send out new alerts and notifications that the task is still pending. I would liken it to a system-generated gentle reminder for escalation purposes. And then if it's not processed, it can be auto-assigned to a secondary approver. The idea is to keep the process moving, so hopefully no fires need to be put out.
Okay, sounds good. And then we have another question for Craig, and the question is there any data that shows how automated underwriting and decisioning impacts cost to cure and default rates? And the questioner explains that in their business feels that every deal is unique in structure and risk, so manual review is unavoidable. In your experience, does automation help decrease the cost to cure and default rates by improving decision quality and consistency?
Wow, what a great question. Certainly, we have to look at kind of the continuum of automated underwriting, and I don't know that anybody does automated underwriting today solely without doing manual underwriting along with that to some degree or another, which is kind of the nature of the times with our regulatory environment and our cautious lending practices. If you look over the continuum of time with automated underwriting, there were certainly periods when we were all in on the automated decision being the decision we went with, but too often those decisions were not looking at long-term performance necessarily, but just whether a transaction was going to fit into a pool to be securitized, if you will, and so it was not looking at the long term of the transaction. So I don't know that it's necessarily that there's good data on that, but I do think that best practices today is always to use the automated decision as an important piece to the transaction, but supplemented with the manual processes, because you get a better feeling for the layering of risk through your manual underwriting processes.
Okay, well, I'm afraid we are out of time. On behalf of Source Media and American Banker and Canon, I would like to thank our speakers, Dana Jackson, Craig Hughes, Michelle Roskin, and Alyssa DeMeo. And thank you all for coming, and I hope you have a great afternoon.